Hello and welcome to CMC Markets and this quick look at the week ahead beginning the 3rd of April. And as if we look back at the first quarter, I think it's safe to say that despite an awful lot of what I would call political risk, we've come out of it quite well. Equity markets still remain fairly well supported. We're certainly within touching distance of the all-time highs on not only US equities but also the German DAX and the FTSE 100, and this is despite overcoming the Dutch elections, another Fed rate rise, and obviously the triggering of Article 50. And against that backdrop, as we head into Q2, I think we're going to be taking particular notice of, first and foremost, the probability of further US Fed rate rises. We've seen an awful lot of hawkish rhetoric out of Fed policymakers, in spite of the fact that in the space of 3 months we've seen 2 Fed rate rises, one in December and one in March, and with the potential for at least another 1 or 2 over the course of the rest of the year. Certainly I think if the forward guidance of people like Stanley Fischer and Charles Evans are any guide, then the prospect of further Fed rate rises remains a distinct possibility. But obviously an awful lot depends, I think, on the Trump trade, and that does appear to be showing some signs of being a little bit tired. Since Mr. Trump got into the White House, we've seen a significant rebound in US markets, up over 10% in some cases, but there is, I think, a risk now that the current rally could well be near the top. That's not to say that we can't push a little bit higher, but certainly I think the optimism that we saw at the beginning of the year is starting to be replaced by a little bit of uncertainty, given the fact that the healthcare bill appears to have collapsed, and ultimately I think optimism around tax reform could be slightly misplaced. That being said, I think the main factors that we need to keep an eye out for this week are the latest manufacturing PMIs, not only from Europe and the UK, but also the latest manufacturing data from the United States, but more importantly, non-farm payrolls. Will we get another decent number in the wake of the decent numbers that we got in February and March? Certainly the likelihood of a decent number is still of a fairly high probability. The Federal Reserve remains fairly optimistic about the labour market. I think the only unknown remains surrounding wage growth. But despite the fact that we're fairly bullish on potentially another load of rate rises from the US Federal Reserve, the dollar index doesn't appear to be reflecting that. We can certainly see that since the Fed raised rates, we have continued to weaken on the dollar, and it's followed a similar pattern, I think, of previous Fed rate rises. I think the market is still a little bit skeptical that we'll get any more than, say, 1 or 2 further Fed rate rises later this year. Much will depend on the data, much will depend particularly on the wages and potentially future GDP growth, set against the expectations of what President Trump can deliver. But I'm paying particular attention to this very key support level that I've drawn through here around about the 99 level on the dollar index. More importantly, going to be keeping an eye on the UK economy as well. We've got the latest March PMI data, which should round up a fairly decent quarter for the UK economy. Yes, it'll probably be an awful lot weaker in terms of growth than Q4, which is likely to come in at 0.7, but nonetheless the pound has held up fairly well despite the triggering of Article 50, but that was always likely to be the case. What we heard on Thursday with respect to Theresa May and her outlook for the Brexit negotiations were not really any different to what we heard in January at her Lancaster House speech. Now what we've seen thus far is we are approaching a little bit of a resistance level on the cable around about just above 126 and the 200-day moving average, and we are approaching some very key levels with respect to the US dollar against a whole range of asset classes. Euro dollar being a case in point, gold being a case in point, and we can see them here. The oscillator is starting to roll over on the pound. We're finding support around about 123.60, 123.80. If we look at the gold, we can see a similar sort of resistance level coming into play. Again, the 200-day moving average, very key, but also a trendline resistance from the highs last year. So again, approaching some very key tipping points with respect to gold, and also on euro dollar as well. And it's significant that we have seen some potentially bearish reversals there. We can come a little bit lower. 50-day moving average I think is key, around about 106.80. If we hold above that, then I think we can then return for a move higher. Certainly in the context of where we go to next, I think euro sterling, key support there comes in around about 85.80. We can see that borne out in the euro sterling chart, and this chart here. Again, we'd still appear to be playing out in this potential triangular formation here. I think it's going to be very, very important in the context of the next few days where we go to next, but I still remain of the opinion that we sell euro sterling on rallies, and it's unlikely that will change given some of the weaker inflation data that we've started to see come out of Germany. The risks of the ECB looking to taper policy over the course of the next few months has diminished as inflation data has diminished as well. So those are the key things that I'm looking out for later this week. Non-farm payrolls looking for a plus 200 number, around about 235, 236. PMI data, construction, manufacturing and services from the UK economy, and manufacturing and services data from France and Germany. That's it for this week. Don't forget to tune in to non-farm payrolls on the Friday. That will be covered live by me and my colleague Colin Szynski. Until then, have a great trading week.